Welcome to the AI Revolution Show. Good to have you in London.
Thanks, Alex. Glad to be here.
Tell us in one sentence, for those that don't know, what is Recap? What does it do?
Imagine you're a SaaS founder and you need some capital and you don't want to give up equity for it. Then we want to be the first place that pops up in your mind. Either you know exactly what you need and we have that at hand, and if you don't know, we help you find out.
A lot of people that go into, let's say, fintech, come from a banking sort of background, right? Like, what was your background? Like, why did you decide to, found Recap?
So I'm not a banker. I've never been a banker. It really, the honest answer, it happened by accident. It was at university. The investing club we had there, that was the first exposure I had to finance. And then somehow it ended up starting a company in the fintech world. Initially, what we worked on was like the wealth tech area. We started working on a micro-investing firm while still being at university, and that then, upon graduation, turned into Liquid, which is like an online wealth manager targeting mass affluent people. Like if you want to invest more than 100 grand, that was what we were looking after. And then we were working on it, and when we left the company, we were how would you say probably infected with the finance and fintech virus, and never got out of it again. And over time, this then led to Recap.
Yeah, I wonder how many. It's probably quite a high proportion of companies that have been started like as an accident without like this kind of grand design. And actually, personally, I don't know how many people know, but SaaStock was like an accident, and it was after 10 years of like all these like entrepreneurial ideas. It was at the point where I didn't actually know what I wanted to do, and then if one thing led to the other, which then became SaaStock. And so often when people ask me, it was like, well, actually, I had no idea it was going to become what it became.
I mean, I couldn't agree more. You oftentimes hear these PR stories where founders say, I woke up in the morning and then I had that thought how I will change the world. I wonder in how many cases this is actually true or just a PR story.
Yeah.
Like for me, it was really like that. I always just stumbled into opportunities. And I think what then actually turns you into a founder or starting a company is just like being crazy enough to just let go, to keep on with what you're working on, and don't shy back from the first things that pop up and tell you, don't do this, and it will never work. And then suddenly you sit in a company. That's at least how it always worked out for me.
And I understand at the outset there was some internal discussion and contemplation about whether to be bootstrapped yourselves or take venture capital. Understand the route was that you did take venture capital. So it would be good to really kind of understand at that time how those discussions went, why there was this contemplation about one versus the other. And also, given in a large part what you provide is an alternative to venture capital, as to whether that weighed into it.
Yeah, I mean, first of all, I must confess, the first company that we started, we didn't think about that at all. For the first company, we were just excited. Somebody is giving us money to start a company. Let's go. That was pretty much it. And yeah, the first company, Liquid, was a VC-backed company. And when we left it operationally, thereafter, we ran a consulting firm for a few years. And that was Bootstrapped, where we just used our own money. And it was obviously also cash flow positive on day one, which was also a nice aspect. So we knew both sides of the world, so to say. And when we were thinking about Recap, then it was more natural to reflect, should this rather be a bootstrapped one, or should it be a VC-backed one? And what are actually the pros and cons for both routes? Ultimately, to cut it short, the main reason for us to do this as a venture-backed case was the conviction that speed and capitalization matters. And fast forward to today, I can also confirm that was the right choice. Other companies that were less well capitalized died along the way. So that was the core reason why we figured that's the way to do it. And on your comment that we are somewhat an alternative to venture capital, or our product offers an alternative to that, like conceptually for us, that wasn't really part of the decision to make this a venture-backed company or not. We always thought about, there are different tools, different instruments in various parts of life, and it's the same for funding instruments, right? And we never tell customers on our platform, you should never raise equity. It's also not that we would say we want to replace all equity in the world. What we are more focused on is trying to make clear to founders that there are certain things you should use debt for, and there are others where you use equity for. And that, again, was similar when we thought about starting Recap. It was also clear we can't raise debt on day one. We need a lot of capital. So what else should you do?
You mentioned that along the way, a lot of similar companies effectively, sort of disappeared. And, we saw that in, it was probably like 2023. I think that was the first SaaS stock post-COVID. Revenue-based financing was this new sector, which was probably the hottest amongst our sponsorship-based. And now we've seen pretty much most of those companies disappear. There's a couple still there, but they have disappeared. Why have they disappeared, in your opinion? And what have you done sort of differently to sustain?
Yeah, so I think a few smaller ones just disappeared because they never, how do you say, crossed the chasm, so to say.
Yeah.
They were just too small, and others like us were already too large, and then they were unable to attract the funds needed to get to an appropriate scale. So these are a few, but that's actually conceptually not the most interesting bit. I think the real interesting challenge in building up such a company is that you need to balance interests of two very different stakeholders. One are your VC investors, who will push you to grow as fast as you can. And the others are the guys who provide the capital that you provide to the companies, so debt investors. And they want to see a good quality, high granularity, high liquidity. They don't care whether the book doubles or triples in a year, or it's just growing 50%. And at first sight, that looks like there is no conflict, but there is. I mean, if you grow as fast as you can, you will end up with certain problems in a credit portfolio. It will blow up at worst case, or it will simply look like something that the larger institutions then don't want to lend against and don't provide additional capital. And I would say, if you look at different players, there are some who grew too fast and blew up. And then there are some who were too cautious, really trying to do it the way debt providers asked them to do. And then they didn't deliver the growth. And then they were no longer an attractive target for VCs, and then they stalled. So these two scenarios I've seen more than once. And what did we do differently? I would say that conflict was clear on day one, and we just tried our best to balance it. But to be honest with you, you can't avoid having some tough discussions and negotiate hard and explain to refinancing parties why that way is the right one, and also to explain to VCs why maybe quadrupling is not realistic and tripling must be good enough. And you need to find the right partners who are willing to back this.
And when you launched, it was kind of at the era of where growth at all costs was coming to an end, and capital efficiency, was the mantra. What was perhaps the impact of then your timing of the launch with that shift in the market? And then perhaps if we look at today with what's happening in AI, like, has there been a change? Is it still capital efficiency? Are we growth at all costs? Is it somewhere in between?
I mean, to the first part of your question, you already answered it yourself. Like, capital efficiency was suddenly a very hot topic. Yeah. Everybody was talking about burn multiples. Yeah. I mean, there was a burn multiple before, but nobody was that much focused on it as during that period of time. And frankly, that played into our hand. not just because people were more sensitive for capital efficiency in general, but also because it was harder to attract equity, and that led them, in some cases, desperately looking for alternatives, which we not always could provide, because again, not every solution can be filled with or provided via a debt instrument, but it just led to an increase in demand, clearly, and that was good for us. Fast forward to today, I would say it really depends on where you sit across the spectrum as an AI company. There are some which I would describe as SaaS companies, for example, heavily embracing how they can change the way they work by means of AI. And for these ones, we would actually say they become even more efficient than they've previously been. And on the other end of the spectrum, you have the ones who embed AI so deeply in their product, which is obviously exciting, but changes the unit economics quite a bit. And suddenly, I don't know, gross margin drops from 85% to 60 or 50%. And then these companies are actually a lot less capital efficient. Still, both can raise equity and in parts huge sums at the moment. So I would say there is not a clear cut at the moment.
Is there a shift for you, given I guess you launched before the AI platform shift? I think the ICP was and still is to an extent, and you can clarify, SaaS companies over 1 million in revenue. Now, we're talking, or we're hearing about the SaaS apocalypse and AI killing SaaS. How do you view the SaaS apocalypse? How does that impact your ICP, your business model? Is it just a natural evolution? Look, we invest in software companies, and the new AI natives are software companies, but they're effectively, have just AI, built within, at the platform from the start. So yeah, maybe share a bit of thoughts around that.
Yeah, absolutely. So I would agree that at the core, our ICP still are SaaS companies, or what they morph into over time, but there are different shapes and sizes of this. So I don't know, where does SaaS end and health tech begin? And same for fintech or defense tech, or there are a few companies where we wouldn't describe them as SaaS, but they are also not completely different. Internally, we just say tech-enabled SMEs. Okay. And this is typically not language that any founder would use, but that's the definition we use, and that also capital providers understand, like lower mid-market companies, SMEs that have some innovative components in it, typically a lot of software, and nowadays also a lot of AI. And actually, diversifying beyond that was a topic for us since day one. We to be honest, didn't focus on that segment just because we liked and knew it, but more because we knew it has a relatively good data infrastructure, which was a prerequisite for our underwriting model to work. And that's why we didn't look too much into traditional companies, because we felt it takes longer for them to have all their data stored in cloud systems and so on. But it was always clear we need to go beyond that sector. And to some extent, you could say, our interest in doing that has accelerated over the past month. Has SaaS apocalypse had such a meaningful impact on how we think about what companies should be financed or not? Not really, because we always, like, one of the criteria we looked a lot into for B2B SaaS companies is obviously how deeply integrated is their offer into processes of their customers. And if it's more superficial, then it can be easily replaced. That was like the past thinking we had, and then the revenue is less sticky, and vice versa. And I think that thinking also applies to how to think about the danger of AI for these companies, because if you are deeply integrated, it doesn't mean you are fully protected, but it still means you have more time to figure out what AI actually means for your model. And the end outcome for us is the same. SaaS companies that are deeply integrated in processes of customers, we like them better.
Yeah. So I guess with that, the SaaS companies traditionally, have had better margins, right? Better gross margins, so lower cost to run. the new AI native companies, it's easier to start a company or build an MVP now, but the cost of running AI, we've seen a much higher, and the margins are smaller. So like with your model, and I think the AI model, and perhaps we'll jump into that a little bit. Does it have like then a preference, and when it's kind of looking at these things, like, okay, well, obviously a SaaS company, there is much more profit, to kind of gain from that, and share a little bit.
100%.
Yeah.
So we always, if I had the choice between two companies, one has, let's say, 3 million in ARR
Yeah.
and gross margin of 90%,
Yeah.
and the other has 6 million of ARR, but
Yeah.
gross margin of 70%.
Yeah.
The first one we like better, and
Yeah.
we think relatively to their size,
Yeah.
you can lend more against the revenue stack.
But what if, and does your model account for this, that let's say in the first instance, you've got a 3 million ARR SaaS company that's 8 years old, that is yet to become, let's say, AI first, but they're kind of looking at that. But then you've got an AI native company that's at the 70% margin. There is this obviously potential threat that the 3 million ARR company, it's great today, but in 5 years' time, is it going to be killed, right? So what is it?
In the end, the short answer to that is obviously gross margin is not everything that drives a credit decision.
Yeah.
It's one of many aspects. And as I said earlier, like how deeply the solution is integrated or how relevant it is to customers is another dimension you look at. And the combination drives, is this financeable at all? And if yes, at what terms? So that's basically how we think about it. Honestly, anyone who would currently claim to know exactly which AI models will work in 5 years, either they really must have found the holy grail, or they are just speculating. And what is helpful for us in that context is obviously, yes, we provide longer term financing, or investors on our platform provide longer term financing, not just for a year. But these transactions are always structured in a way that you can mitigate changes along the way, and it's not like an equity investment where you are in and you are in forever, and that obviously gives us a bit of confidence.
What about your, I guess, Recap's own journey with AI? When you started to, when did you start to see the platform shift? When did you start to see we need to start building AI, into our tooling, and maybe share what you can in terms of what you've done?
Yeah, so we work with AI in our product since we started the company, but old school AI, I shall say, so machine learning. In that context, we mostly use AI for structuring and enriching data. And even up until today, we still predominantly use machine learning for it, also for cost reasons. It takes less compute. And at least as of now, we still see better outcomes, better accuracy. But LLMs are catching up at a crazy pace, and we are sure they will take over quickly. And then it's more just a question of compute. I mean, every day there are tens of millions, hundreds of millions of bank transactions that we analyze and tag, and that can quickly get very, very expensive. So that's why we still use old school AI in that context. And then over the past 1 to 2 years, we started experimenting in our product a bit more with how exactly we can leverage what LLMs are capable of. I think the biggest impact for us was we knew so when we launched, that was mid of 2022, and it took us roughly a year to get to product market fit and understand how do you need to position this product so that founders actually understand and appreciate it. And a key insight always was there is lots of consulting work happening around such a transaction. How can you ever automate this? And traditionally, there was no clear answer to this, and that's why personal interactions were just more important. Now we feel we actually see a path that would allow this, and that is where stuff like Capable AI, which we may talk about a bit later, comes into play. Lastly, and that is probably, it might be a bit counterintuitive, but I actually heard similar stories from other founders as well. the last thing where we actually heavily started to use AI is in our own workflows. So for the engineers, it's obviously a bit more advanced already. But for the other teams, it's really something that took place in the last 3 to 6 months, I would say. And that was ironically for me the biggest wow moment. I mean, I was also genuinely impressed with what our product can, but when you see how hefty it affects like your own daily work rhythm, that is where you then realize, wow, this really changes everything.
What sort of examples can you share there, like tools that you're using to, automate the workflows, maybe in certain departments, and the impact on, productivity, efficiency around that?
I'll give you 2 examples. One, just in my own routine, I'm going to an event and I try to find out whom I should talk to. Historically, how would you have done this? Like going through the list of people who attend the event, doing some research on it. Probably you would have delegated it to a junior colleague or 2 if it's urgent. How do you do it today? You just scrape the list and let an LLM do some research on it, and then it directly pushes the outcome into your CRM, in our case, Etio, and there you go. It's day and night. Historically, 2 juniors working on a larger event for, I don't know, a full week compared to a good prompt and 2 hours.
Yeah.
So that's one example that what was for me like really one of these moments where I thought, wow, in great times we're living in. And the other, which is a bit more operational for us, so for compliance reasons, we also still need to document credit decisions. How does such a memo come into place? And this is now something where we have all the data in place, and we can easily, fitting to the case, generate these memos by now, which previously, like a year ago or so, were still to a large extent created manually. And that is on a company basis, probably for each deal, like 2 days or so in time that you just save. And that is also very impressive.
How much of the business would you put a weighting on the tech versus the people side of things to I guess achieve your goals, and having is it very much if we think about it perhaps in the old world, and we're talking about funding here, that would be very much a relationship sort of like driven business, but given that you've got this capital OS system, it's like is there any kind of weight? How important are the humans versus the tech?
Yeah, you already named the most crucial aspect. It's still a relationship game.
Yeah.
I was actually surprised to learn this previously when we were working on Liquid, like a wealth management company. People, they send you their money for you to look after it and invest it. That this has something to do with relationship and trust was very clear to me.
Yeah.
When we started Recap, I was thinking like, why should people care about the relationship? I mean, they get our money, so everything is good. But that's not the full story. Most founders actually want to know, is this a reliable partner? Do they understand what I'm doing? Does this actually fit to what I'm looking for? And so on. As of now, I would at least say that's nothing that technology can solve for. And it's also nothing that, in my view, technology needs to solve for. It's great if people, in that case, in our sales team, have more time to do exactly that and need to invest less time in documenting things or similar aspects. So we internally really see technology and AI in current times in particular as something that just enables you to work on the more valuable things that really deserve human attention.
And on the human attention and the relationship, also, is it equally split, or a lot of it front weighted on acquiring the customer, to become an account of Recap versus account management? Just in the past, I've taken a small bit of debt funding, and it was, I guess, relationship driven from somebody that I knew. Yeah. But after we got the funding, the relationship then just kind of moves to chasing of invoices, or
I'll I would try to answer that with kind of a weird anecdote. You know, when you sometimes wonder how did you end up in life where you are right now, then you come up with like the big things, what you worked on for many years or so, and obviously that took most of your time. But another way to look at it is there are these smaller decisions you took along the way, maybe even unconsciously, like spontaneously meeting someone who then turned out to be the crucial person that opens a door that later on made you start a company. What I'm trying to say by that is, in our daily business, I would say if you just look at the sheer volume, the amount of work, then technology is certainly the more important driver. But I would still say that the human piece, maybe not on a volume basis, but on an importance level, is the more important bit for our current audience and the current product that we have. So 2 ways of looking at this.
You mentioned capital AI earlier. Like, what is it? I don't know. What the audience perhaps doesn't know. What is it?
In the end, it's an embedded LLM into our platform that has access to all the data that you as a company have connected to our platform that we have already structured and enriched. And you can use it in a multitude of ways. Like obviously the standard thing we all got used to by now, opening ChatGPT or Gemini or whatever you're using and asking certain questions. You can do the same on our platform, but it has the context of all your financials. That is one way to use it. And the other more interesting bit in our view are agentic use cases where you define certain things that you want our platform to look after. For example, you want to be notified if someone on your sales team is expensing suspicious things. So you no longer need to worry about it, and then it will do via the channel that you like, email or on the platform when you log in for the next time. And that's just one example. But for us, it's the overall use case of what we are focusing on in the agentic AI context is a bit peace of mind. There are always like a few eyes, AI eyes, looking at your financials, and you can be sure nothing slips your attention. And at the same time, you don't always need to look at it yourself and have all the noise you don't want to see anyways.
If you sort of look into, let's say, the next 2 years, let's say 2028. What are your thoughts looking in the crystal ball of what the debt funding space might look like in 2028?
You know, when I get questions like this, like historically, what I would have always said, and actually I would still say it today, is my projection is more early stage companies will use debt funding, and we see that. Clearly, more companies do this today than they used to do it like 3 years ago. The only way why I would be a bit skeptical about it is what you currently see in the media, and you don't really know how much of a backlash there will be. And in the end, we are also just one provider, and you need a whole ecosystem to really change this in a meaningful way. And there can obviously be some setbacks if certain large institutions shy away from this. But I wouldn't expect this, to be honest, and I think more companies will use it for good.
During COVID, a lot of companies stopped looking so far ahead in the future and started looking like quarter by quarter. And obviously, like traditionally, let's say a lot of companies would build a 1-year plan, a 3-year plan, and a 10-year plan. We are obviously, in still a strange world, but a fast-moving world and a very exciting time, for software, given AI. How do you run the business? Are you looking 10 years into the future? Are you more concerned about the 1-year goal, or what's happening, quarter on quarter?
So we internally still operate under the same principle, which basically is there must be a vision, a very long-term vision, and there must be a strategy that we believe can bring us to that vision. And the rest operationally is trial and error, but still having that idea of where you hopefully want to be at some point in time. I think what has changed for me on a day-to-day basis is really more the pace or intensity of new things popping up. I mean, both of us are working in the startup and tech ecosystem for some time. I mean, we are used to seeing innovation on a very frequent basis. But I think we can also agree that what is happening like over the past few weeks and months is completely different. It's so much faster, and that sometimes leads me to question how much long-term planning is actually still worth if the very foundation of everything is actually undergoing so much change. But I still stick to it. And again, for me, it's also peace of mind. I am opportunistic, but being purely opportunistic is nothing that doesn't make me happy. I need to have some idea where I want to go, and then I rather reiterate how exactly I will go there.
Undoubtedly, we will, have a SaaS founder who's at 3 million ARR, 90% gross margins, but only taking VC equity to date. Sort of like with that in mind, and listening as they are listening, like what advice would you give to this person, this company?
So first of all, I would challenge that person. Does she or he really have 90% gross margin? And do a calculation on that and be honest to yourself. And then when you do that, then you will end up with different cost items. And then you can just ask yourself, is this something you should use equity for, or you should use debt for? And then you will, when you're into it, find items like R&D investments where it's very clear you should use your VC money on it. But maybe you will also uncover a few pure acquisition cost items that deliver a return in like 6 to 9 months or so. And this is something where you will then clearly observe this is nothing you should use equity for. So my encouragement would be take a look at your P&L, take a look at the figures that you report, and just look at the cost items and find out if you use the right instrument for these.
Is there something about Recap that nobody asks you, that maybe nobody knows, that you've always wanted to talk about?
About Recap in particular, not necessarily. The thing about what I think people oftentimes don't ask, or never. I've actually never been publicly asked about this, but I do think it's relevant in the context of what we are doing at Recap, is what is actually the emotional cost of a bad financing or funding decision. If you are thinking about that, then oftentimes people just compare what is the cost of capital and where can it bring me, or where will I end up with that. But we've met so many founders who accepted like a too high liquidation preference, or who had have just raised too much and then find themselves in a situation where there is literally nowhere to go. And if you are then a true founder and committed to your business, that can put so much strain on you mentally, not getting out of it. And I think asking yourself, if you make a financial decision, also what can be the emotional consequences of it, I would appreciate if more people ask this.
I guess segueing on the emotional side. So you're also, I know you were at an event earlier doing the podcast. We've got a dinner tonight with about 12 other SaaS founders. I'm sure many of them are going to be asking, is AI killing their business? Maybe in one sentence, if you were speaking to the whole group, what would you say if they all said, Paul, is AI killing SaaS?
Absolutely not.
There we go. All right, Paul, thank you so much for being a guest on the AI Revolution show today. Really enjoyed the conversation. Looking forward to continuing the conversation over dinner this evening.
Thanks, Alex. That was fun. And that sometimes leads me to question how much long-term planning is actually still worth if the very foundation of everything is actually undergoing so much change. But I still stick to it. And again, for me, it's also peace of mind. I am opportunistic, but being purely opportunistic is nothing that doesn't make me happy. I need to have some idea where I want to go, and then I rather reiterate how exactly I will go there.
Undoubtedly, we will, have a SaaS founder who's at 3 million ARR, 90% gross margins, but only taking VC equity to date. Sort of like with that in mind, and listening, as they're listening, like what advice would you give to this person, this company?
So first of all, I would challenge that person. Does she or he really have 90% gross margin? And do a calculation on that and be honest to yourself. And then when you do that, then you will end up with different cost items. And then you can just ask yourself, is this something you should use equity for, or you should use debt for? And then you will, when you're into it, find items like R&D investments, where it's very clear you should use your VC money on it. But maybe you will also uncover a few pure acquisition cost items that deliver a return in like 6 to 9 months or so. And this is something where you will then clearly observe this is nothing you should use equity for. So my encouragement would be take a look at your P&L, take a look at the figures that you report, and just look at the cost items and find out if you use the right instrument for these.
Is there something about Recap that nobody asks you, that maybe nobody knows, that you've always wanted to talk about?
About Recap in particular, not necessarily. The thing about what I think people oftentimes don't ask, or never. I've actually never been publicly asked about this, but I do think it's relevant in the context of what we are doing at Recap, is what is actually the emotional cost of a bad financing or funding decision. If you are thinking about that, then oftentimes people just compare what is the cost of capital and where can it bring me, or where will I end up with that. But we've met so many founders who accepted like a too high liquidation preference, or who had a too have just raised too much, and then find themselves in a situation where there is literally nowhere to go. And if you are then a true founder and committed to your business, that can put so much strain on you mentally, not getting out of it. And I think asking yourself, if you make a financial decision, also what can be the emotional consequences of it, I would appreciate if more people ask this.
I guess segueing on the emotional side. So you're also, I know you were at an event earlier doing the podcast. We've got a dinner tonight with about 12 other SaaS founders. I'm sure many of them are going to be asking, is AI killing their business? Maybe in one sentence, if you were speaking to the whole group, what would you say if they all said, Paul, is AI killing SaaS?
Absolutely not.
There we go. All right, Paul, thank you so much for being a guest on the AI Revolution show today. Really enjoyed the conversation. Looking forward to continuing the conversation over dinner this evening.
Thanks, Alex. That was fun.